Hi everyone, it's Mark Masterson again, Managing Director and Partner at HighTower Naples. Welcome to my April of 2018 video market commentary. We have a lot to discuss today and to share with you, as it was, as you all know, an interesting first quarter. So thanks for joining us and listening again, and I'd like to jump right in. As we do each quarter, we start this commentary with our overview and review of the Four Horsemen. I've highlighted in red this time a few of the new developments just to kind of make them stand out. And so let's go through and take a look at what changed from the first quarter to this quarter. We'll start in the fundamentals. And as you can see, we do remain bullish in the fundamentals. We think things are generally improving in terms of GDP. Fourth quarter GDP came in at 2.9%. That's fine. And most important, perhaps, we think the first quarter is going to be light. I'll show you in the next chart why that is. Just tends to be light in the first quarter. But first quarter GDP is going to be light, and we expect it to improve for the remainder of the year. Fundamentals are fine. So technical analysis, again, still bullish there. A lot changed. Definitely it's been wild, but nothing has been damaged technically in terms of the charts. I'll show you that a bit. We're not going to dive deeply into that in this. As you know, if you follow me in the morning roundup, I cover that quite a bit on a daily basis on the blog. And so you're happy to please join us there, and you'll see more of that. But generally speaking, positive technically. Sentiment has improved. When we started the year, we were neutral there. Huge shift took place in the first quarter with all the volatility. When we began the year, investors were pretty wildly bullish. That's all washed out now. That has changed. So this is a positive because negative sentiment tends to be a contrary positive for the markets. We are quite negative at the moment in terms of sentiment, so we're improving from how that impacts the Four Horsemen. And then finally, policy. When we started the year, we knew that the fiscal policy was improving because of the deregulation and the catalyst of the tax cut. All of that is good. We do know that there is a risk that the Fed might move too fast and too far. I think that's a pretty low risk, but it is a risk, and markets don't like that thought. Perhaps the biggest change, though, is what took place at the end of January, early February, where President Trump announced tariffs. And, it's hard to say the impact of those. It's very hard to quantify those because, quite frankly, the negative impact could come from retaliation. The initial tariffs that were rolled out on the aluminum industry and steel really were watered down quite a bit and kind of a non-event. Now we're seeing more tariff talk around China. I guess the biggest impact there as a policy and why we went to neutral on this versus bullish, the tax hikes positive, deregulation positive, tariffs, there's just not much upside there from our perspective. And the uncertainty that it introduced was a negative. So it is a headwind. Again, hard to determine exactly how much, probably not all that much, but it certainly impacted markets. So from a Four Horsemen standpoint, this is what how we view things and how things have changed. So moving on, let's take a quick look at some of the fundamentals. Really only one chart here. I mentioned during the Four Horsemen that first quarter GDP is going to be light. How do we know? Well, we know because some of the data has turned down a little bit here in the first quarter, but more importantly, it seems to us that the first quarter is always light. If you go back to 2014, 15, 16, 17, 2015 was pretty strong in the first quarter and then tailed off from there. I actually would expect 2018 to be the opposite of that. And as you can see, 2014, it was the worst quarter, and then we went up from there each quarter. Same thing in 2016, and then 2017 was the same. So 2018, expect a light first quarter, and then we'll move higher from there. And the bright side to that is simply that if the first quarter comes in light as expected, the expectations of the Fed raising rates or accelerating their rate hikes will probably be dialed back, and the markets will like that, I think. So that's where we are in terms of the GDP picture. Moving on to equity markets, which is where we'll spend probably the majority of our commentary today. Let's take a quick look back. When we started the year, we highlighted this chart, and this was in our first quarter commentary. And what we showed here was one of our expectations for 2018 was it's going to be a good year, but we expected volatility to increase. Why would we think that? So Strategists outlined in this chart that in years in the past, going all the way back to the basically 1960s, whenever we had a year like we had in 2017 with very low volatility, you can see only 3% drawdown last year. Every single instance of very low volatility was followed by a year where volatility increased. So our expectation was coming into the year that we were going to have more volatility. We had a question mark there. Well, that question mark's been answered because, so far in the first quarter, we had a drawdown of anywhere from 11 to 13%, depending on whether you look at closing or intraday values. So volatility came back. That's a check mark. That doesn't mean that we're going to have a negative year. As you can see, oftentimes they're very good years when volatility increased. It just means we expected volatility to return, and return it did. Another chart that we love that I've shown many times is this chart showing historical information on returns for the S&P and the volatility that took place in each of those years. So quickly, if you look at this chart, these gray bars are the returns for the S&P 500, calendar returns for the S&P 500. And so you can see, good years. Last year, 2017, market was up 19%, and then we add the dividend to get to the 21. So all of these are good positive years, and a few negative years, of course, mixed in for the S&P. These red numbers are reflective of the drawdown that took place intra-year. So last year, we had a good year for the market with only a 3% drawdown. That's a very small drawdown. The point of this chart, as I highlight down here, is this. Volatility is a constant in markets. So here we are year to date through the first quarter. The market's down 1% with a 10% drawdown. It sounds terrible until you look at this and say to yourself, wow, 10% drawdowns are frequent. They're common. This was the anomaly. A 3% down year is an anomaly. In fact, over this time period, there was only one. That was back here in 1995. And that period was the beginning of the end of the bull market with great years, 5 great years of returns, but volatility increased along the way. And maybe we'll see that, maybe we won't. The simple point, though, is that volatility is normal. A 10 or 11% pullback happens all the time. Just look at the chart. 13% up year, 16% drawdown. 30% up year, 6% drawdown. 26% up year, 14% drawdown. Volatility is a constant. That's what we need to understand from the chart. So in my morning roundup, I've shown this chart a number of times, and I've done so for a couple of reasons, because this shows 2 corrections that took place. One was in 2016, early part of 2016, and the other was in 2015. And I wanted to highlight this with an A and a B just to show clients, as we've been working through this, what I call complex correction in the markets that began since February. What you see is a double bottom is very common. In the case in 2015, we had a double bottom where the second low didn't break the previous low, and then in B we had a double bottom where the second low broke it. But there's two points to the chart. Double bottoms are common, and 2, every time you go through something like this, whether it was this one or any of them that have taken place, including the one we're in, they're scary in real time. The point of a correction is to wash out sentiment. And these 2 both did that, and they set the stage for a very nice rally. And I believe the correction we're in now is doing the same thing. I keep asking clients, I said, hey, do you remember in 2015 and 2016 what caused this or this? Nobody can remember. But when you're going through it in real time, oh boy, every headline, every article is front and center, and it's on your mind. So keep that in mind, especially as I show you the next slide, which shows you where we are today. So this is the correction that began in February. We had this very calm end to the year, rose right up through January. First sell-off, rally, second sell-off. I keep saying this looks more like B. You see how we have the sell-off, rally, and then the further sell-off with an undercut? That looks to be where we are here. We have the sell-off rally, and then we have an undercut here. I will point out we are oversold, and anytime we get down in these levels, it's usually time to turn. Same thing up here. So, this is kind of where we find ourselves. And in my view, this is playing out like any other correction, complex correction, grinds down sentiment, and we're about done with it. You can see that fear has returned with a vengeance. This slide is extremely busy, but what we have here is some things that I've been covering in the morning roundup. So the fear and greed index registered the other day with a 6, very, very low. Investor sentiment has been washed out. See this green? That was bullish sentiment when we started the year, and now we're down here, way down. Here we have, again, we're looking at S&P sentiment plumbing a 3-year low, and then down here, and then we have the put to call ratio again. So you can see where we hit last week is kind of in line with previous lows. So fear is back. That's the whole point of this, and that's what corrections do. Corrections wash out positive sentiment and set the stage now for a rally from here. I showed you the chart of the S&P. This is the NASDAQ 100, so the larger names in the NASDAQ. And I just sent this chart to a client because I wanted clients to see this. You can see the volatility that's been taking place since February. And this correction has basically brought it back down to the bottom of the channel. We're washed out in terms of sentiment. We're in the buy zone here. We're oversold. We're in the buy zone here. And again, it's just a matter of time, typically, as you can see in the past, where the sentiment gets washed out, the market gets oversold, and then it's time for a rally. So I thought I'd highlight a few reasons for optimism, historical. We'll start with this, some historical data that I found kind of interesting. The beginning of the year was huge. As you know, January was up strongly. So here's a statistic for you. When the S&P's up over 5% in January, the full year has never been lower. We're 12 for 12 when that has taken place. In fact, also when the first 5 days are up over 2%, the S&P's higher 15 out of 15 with a very strong 18% average return. And a positive January historically led to a positive year 86% of the time. So history's on the side, as you can see, where in the past, when we had a good January, here's the January return, here's the rest of the year, here's the full year return, all very good. I will even highlight, how about 1987? 1987, we saw October, the market crashed over 20% in one day, and it still ended positive for the year. How about that? And here's the intra-year pullback. So again, our intra-year pullback is 11, 12, 13% so far, very much in line with historical data. And again, our expectation is that we're going to have a fairly strong positive year this year. One of my favorite charts, which we've shown now for about a full 12 months, is this chart showing bear markets when they end, bull markets when they end, and what takes place in terms of returns in the last 12 and 24 months of the bull market. I will tell you, you don't want to miss them. So this is still our theme that we're likely in the final couple years of this bull market. And I will tell you, here we go. Last 24 months of all of these bull markets. This is the peak. This is when they ended. Here's the returns over the last 24 months. Here's the returns of the last 12 months. And here are the averages, median, etc. I still think this chart holds, and I think it's something we need to keep in the back of our mind as we ride through volatility. Another positive, April's usually pretty good. This chart shows you that. So we'll see what April brings this year, but typically April seasonally is a very good month for the markets. And this chart showing fund flows. I can't get enough of this chart from JP Morgan. I had to wait for it, which is why my commentary is a little bit later. But guys, take a look at this chart. This shows asset flows. So year to date, we have a whopping negative $11 billion out of U.S. equities. I guess that's not shocking given the volatility that we've seen. But I just can't get over, I hear so many people talking about how U.S. stocks are in a bubble. And I can tell you I've never seen a bubble end this way. Let's look at the flows going all the way back to 2009. So if this is when this bull market began, supposedly, this is pretty meager flows. 33 billion in, 34 out, 30 billion out. Here's some positives. But then in 15 and in 16, both negatives. Last year with the S&P up 21%, we only had 13 billion net positive inflows. This is not how bull markets end, in my opinion. Bull markets end with euphoria typically. Let's take a look at the bond market. This is a little worrisome to me. Here's taxable bonds. So last year, 392 billion went in. Okay, I don't understand that, but that's what took place. 48 billion already this year. Look at the numbers, 54, 226. Yes, there was one negative, but this, if we were to try to call something a bubble, which is thrown around rather loosely these days, I would say taxable bonds and fixed income is much more a stronger candidate for that label than equities. So I would tell you, we're seeing some flows into world equities, but the U.S. market is still widely ignored. And to me, I like that. That gives me confidence that the bull market case and the fact that we likely have a few good years at least still ahead of us is pretty strong. So moving on to fixed income, a couple charts to show you here. You know our base case. Our base case is that interest rates are bottoming. We're in the bottoming process. It's going to look something like this. I would caution you, and anyone really, about trying to get too cute with this. I think that it's going to take a while. Nobody knows exactly when this bottoming process is over. This could drag out with interest rates just chopping along the bottom for a few more years. So if rates move sideways for a few more years, a year or two, don't know, and then they're going to start a gradual rise. That's our base case, but we are not going to try to predict exactly when the bottom is, as so many are trying to do today. Let me show you another chart that I think is interesting, because a lot of times clients will say, but if rates are going to move up, maybe we should just get out of bonds. And we say no. We need to have bonds as part of our asset allocation and diversification. And I show them this chart. And because if I were to say to you, if you think about a period of time when interest rates were really rising, you'd have to think of the 1970s. You know, rates peaked really in 1980. So we know that interest rates were climbing. This is the 10-year Treasury bond. I highlight this because if we know that rates were really soaring because of inflation back in the 70s, wouldn't you expect bonds to be decimated? In the 10-year Treasury, which is kind of the benchmark for fixed income performance, would have been terrible. Look at the chart. It's not terrible. It's not catastrophic. It's actually just fine. So here's 70. We had a 9, a 2, a 4, a 2, a 3, a positive 16, positive 1.3. Yeah, a couple negative years, but this is not catastrophic. It's actually quite good for a conservative portion of the portfolio. So we emphasize that to highlight a couple things, that you just never know exactly how it's going to play out, that bonds remain part of our asset allocation. Yes, we are underweight fixed income because we think there's opportunities other places, but we are not eliminating bonds from the mix. They do provide diversification, they provide permanence, they provide income, and they belong in a diversified, risk-managed portfolio. I'll also highlight this chart showing, because another concern that we hear is that, well, when interest rates rise, it's going to crush the stock market. And the reality is, historically, that hasn't been the case. In fact, if you look at the chart, this goes back to 1962, and it shows different windows where interest rates started rising. So here's the beginning, here's the end, here's the peak. So these are all windows of rising rates, and these are the performance of the S&P. I would tell you there's nothing wrong with any of this information. I mean, yes, there's a couple of negative years. There's one here, and there's a couple here. But the negative years weren't too bad, and the positive years are pretty good. So I would warn you, don't draw too many conclusions about rising rates and how it's going to impact stocks, because, in fact, most of the time it's been positive. So lastly, let's take a look at real assets and currencies. Let's start with the dollar. As you know, our base case is that the dollar's heading lower. This is a long-term chart I've shown a few times, 20-year chart of the dollar. We think we had a triple top here, just like we did back here, and the dollar headed lower, and we think we're heading down towards the bottom of this channel. It's not a straight line. It's probably going to play out over a couple of years, but dollar's down this year as we expect, and we think that's going to generally continue. History suggests that Republican presidencies are weaker or create a weaker dollar. The red is Republican presidencies, and that's what's taken place. So we think that's going to continue to weigh on the dollar. This chart that I've shown many times with the dollar here and the euro here, we knew this was going to close. It took a lot longer than we thought, but now the euro's moving up, the dollar's moving down, just like it has in the past, and likely they'll just cross over and we'll have the dollar kind of keep moving down and the euro will probably keep moving up as they work against each other. So what's the impact? Well, First of all, we think there's going to be a positive impact on gold. This is a chart of gold. You can see it's been in an uptrend, a very choppy uptrend, but kind of still stuck in this big basing pattern. I will tell you, this to me looks pretty bullish. If it finally breaks out of here, maybe if gold can finally hit 1400 and start moving higher, if that dollar moves lower, you're going to see a pretty strong move in gold. But it's been a very choppy move higher here. I think that's a positive, will be a positive. And this is another just close-up look of the choppy rise in gold. Bottomed back here in 2016, had a nice rise, a sell-off, and now we're kind of just grinding higher. So why do we hold gold? I've shown you this chart, but I like it because it gives you some perspective. Look, gold's a good diversifier. It tends to perform pretty well. You can see the average return going all the way back to 2003 is pretty solid, has some really good years. Everybody remembers this 3-year bear market. That was rough. That's behind us. It's not going to happen again anytime soon. We think gold's moving higher. That's why we hold it. Good diversifier for clients. Commodities are another thing that should benefit when and if the dollar finally does start to really break lower. Commodities have been horrible. You can see on this quilt of returns where commodities have been kind of in the cellar here for 6-7 years. That's going to change eventually, and so we think that actually there's value here, and when the dollar starts to move lower or if inflation starts to rise, commodities will be a good place to be. We're very, very light there now. We'll probably increase for clients when we see some signals. We're starting to see some trends changing. So this chart shows commodity performance versus the S&P. We're at the very low end of the range where commodities underperform stocks. When this turns up, you're going to see commodities outperform stocks, kind of like it did here and it did here. We're just waiting for the turn. And then also this chart I've shown you of the Bloomberg Commodity Index. Stuck, looks like the gold chart, just stuck in a base. And when this base breaks out finally, we'll add to the position and it'll be a very strong move, I think, higher for commodities. So we got our eyes on that, and we think that'll be a positive development for investors. So summarizing where we are, what we expected coming into the year, we thought stocks were going to deliver another positive year with a bit more volatility. Well, the volatility part has played out so far. We haven't seen the returns yet, but we believe they're coming. Still neutral on bonds. Risks may be to the downside, but we're underweight. We're not eliminating the position. Commodities will head higher eventually. They're all kind of stuck in a trading range right now. That one hasn't played out yet. Dollars in decline. And our tactical additions include financials if rates rise, defense, technology, all of which are kind of treading water at the moment, of course. And what to expect in the coming quarter, second quarter. We think equities are going to recover and see new highs. Volatility will resume probably towards the summer when we get to the midterm elections. We think we're about done with the volatility for this wave. We think bonds are going to recover their losses and have a decent bounce, especially if first quarter GDP is reported lighter, as we think it will be. And eventually, we'll keep looking for these buying opportunities when we see a breakout in gold and commodities. Dollar will probably rally a little bit and then fall later in the year. So that's kind of our take on where we are. Let me show you this page. This is my required legal disclosure. So you have that. And finally, my contact information. So again, thank you for joining us on our call. If you have questions or concerns, you can reach us at these numbers. You know where to reach us, most of you. If not, you can go to our website here and sign up for the morning roundup and follow along on a daily basis. So be well. We'll talk soon. Thank you for joining me.